Welcome back to another Market Insight Call, joined as always by Aaron Tuttle. Last time, tariffs, tax bill were in the headlines. We brought on Christina, our Chief Planning Officer, to go through the tax bill. I think she's the only one who's actually read it. Congress didn't read it. And the only person in St. Louis I know that likes tariffs, Dan Goeddel, our Chief Operating Officer. Let's get to it.
Before we get to it, I just want to make a quick announcement that this is the first Market Insight broadcast with Chris's new title. You'll see it under the screen. He is now a partner of Gatewood Wealth Solutions.
Way to go, Chris.
All right, let's get to what really matters. And going back, I know you like to be a student of the drawdown game.
Yes.
So this is the same slide we used last in February, which was before the market pullback. And now we can finalize it as we've seen the pullback. Once the chart gets back to zero, it means we've gotten back to all-time highs again. And that's where we are on the far right of this screen here, which is about a 20% pullback, 18%, recovered to all-time highs recently.
You know, it was scary at the beginning of this year. We kind of had a black swan with Liberation Day and way more aggressive tariffs than anybody expected. But we've worked our way through it. You know, I want to give a shout out to our CEO, Aaron Tuttle. We have a Monday morning meeting with all of our advisors, and that was the low. At the time, we didn't know it was the low, but panicked clients are sending emails and calls. And Aaron, as our fearless leader, had the resolve. I want to read this quote. I wrote it down that day. He said, "Since 1957, there have been 12 S&P 500 corrections greater than 20%. Half were between 20 to 30% drawdowns. 3 were between 30 and 40%, and another 3 were greater than 40%. So if you have cash, don't overcomplicate it. Invest half now, another quarter at the 30% drop, and go all in at the 40% drop, because you may only get 1 or 2 of these chances in your life." So the policy we gave to our advisors is for clients with long-term cash, meaning they're not going to spend it short-term, they're not going to spend it mid-term. This is long-term, which we debate that border, but typically 7 to 10 years or more. We said put half your dry powder in. So that week of the lows, April 7th, our advisors called the clients with dry powder. We stuck to our guns. Some clients we just had to fight to keep invested. But Aaron, I think your guidance was incredible, you know, backed by the investment committee, of course, and our advisors really executed well. So a lot of clients bought the dip. We're lucky it did not turn into a bear market. There's another year this market correction reminds us very much of.
Also, in a great call by the team, credit to our clients. They sent in about $8 million in cash, and most of it got invested by that time, with a little bit lingering, and fixed income purchases different. But we were aggressive on the equity purchases, and they didn't blink. They sent money to get invested.
Yeah, and what was amazing is a lot of institutional investment money managers, hedge funds, family offices, they revised their S&P 500 targets way down. They said a recession is imminent. They were totally panicking. It's the same people, that in COVID said, we're going to have a Great Depression, inflation is transitory. They called imminent recession. It's the same group of people, the usual suspects, these failed economists came out of the woodwork. And I think we continue to be very good practitioners for our clients. And I think credit to you guys and your leadership, and to our advisors for executing well, and for our clients for trusting us.
Something I always go back to, I've said it on here a lot, is the 2022 market, where we did have a pullback that lasted it was a short period. It wasn't a V-shaped recovery. It looked like a V on the charts, but it took a year to recover, and it's going to take time to recover. And what we'll see, we'll talk about tariffs, if they're going to stay on, and if they come off. I think they end up coming off eventually for one way or the other. But I think if that pullback remains, it's a lot like that year, where it just takes time. The market will move past it. You guys, I'm sure, were talking to clients nonstop about Russia, Ukraine at the beginning of that year, and then you stopped 6 months later, and the market starts recovering, and it's still going on. You're still getting bad news out of there, and it doesn't affect the market anymore.
Well, and I think it comes down to a feeling of uncertainty, and a lot of people dealing with the emotions that come with that uncertainty. So through that processing of those emotions, I think that you really can see what happened in the market. Mm-hmm. People process through their emotions of uncertainty during that instance, mm-hmm. and then they, on the other side, have seen benefits of not reacting too emotionally.
Yeah, and I think something I'd love for you guys to weigh in on, the PE multiples for the S&P 500 are a little bit below where they were pre-pandemic. And if you look back in the past 5 years, the resiliency of the U.S. stock market has been incredible. And I'm curious, At what point, if you had a stock that was this resilient to crises, it would get a higher PE multiple over time. I'm curious, where do you guys think multiple should be? Is the market overvalued, undervalued from your perspective?
It's a great question. We don't go into PE multiples too much. We use them because they're more of a trading signal, a headline number. What really matters is, because that's the flaw in the PE multiples, it's the current price and it's 1 year of earnings. So you're really only looking at earnings that affect 1 year and a discount. That's only 5% of the value of the stock. But it is elevated to what you said. And if rates stay where they are, it's going to take some time. Usually what happens is the market will stay flat for some time as the market grows into the elevated PE multiple. But if we start seeing a decrease in interest rates, increase in Fed cuts, over time, the PE multiple can make sense.
Yeah, I would agree with that. If interest rates are going to stay where they are, there's no reason to increase your justified PE, because that's what's going to make the big impact. I think we're going to climb the wall of worry, where we're just going to see earnings growth continue to grind upward as companies start to figure out a lot of efficiencies. And I think that actually increases with a higher interest rate because there's not a lot of financial leverage. People actually have to roll their sleeves up and figure out how do they add value. And we're seeing that happen now. So I don't see a big multiple expansion causing a lot of appreciation in the stock price. I see just a steady eddy increase in those earnings going forward.
Well, something I'm seeing, the same economists and firms that predicted imminent recession, about half of them are back in the market and saying, we got it wrong, course correction, back to our original forecast for the year. About half are saying bad economic data is going to work its way through the system. It's just taking time to see the impact of tariffs. Second half of this year, we're going to get really bad numbers, and we are still right. And they've really doubled down. So I'm curious, what are you guys seeing in the data that
tariffs are always just it's a blockade on your own country. These are acts of war. It's silly to impose this on yourself. That being said, at the end of the day, it's a tax, and taxes are not going to have a huge impact whenever they're low. We're going to work our way through it. So we've said on these insights that there's a lot more noise being made than there is a problem here. And we'll see what the letters come out as. I know the Penguins didn't get their letter this time yet. Hopefully that comes out soon so that we can start to call the bottom of this tariff fear. But the tariffs are going to be, if you're focused on the tariffs and you don't understand how the CPI is calculated, you're going to miss this. And I think we've said that since the beginning of the year.
I'm still amazed on how many, you reference it, PhD economists that come on TV and will say this is inflationary. Look at it in the CPI and they'll reference a couple price increases, but they don't reference the decreases or the slowing elsewhere. And to your point that you've been saying, that's not inflation, that's select increase in prices, but the basket isn't increasing aggressively. The Fed's going to feel okay where they're at.
Right.
As you know, I hate tariffs, and we've gone through this multiple times. But let me put the data to exactly what you just said, which is to look at federal tax receipts. All we need to look at is corporate income taxes and the tariffs, $300 billion. That's just an estimate. We don't know where they're going to come in. To your point, they come in below that, market's going to be totally fine. If we start throwing up the numbers that we're saying now, once we're back to these letters, it's a 15% plus tariff rate. You're going to see that number above $300 billion. It's going to hurt corporate earnings because it's similar to a corporate income tax. So just looking at those two, $600 billion in taxes, if we add back another third in taxes to them, it's pretty similar to comparing where we were in 2017 before the Tax Cut and Job Act, where we were at 35% corporate tax rate. Now we're at 21. It almost puts us back in line with where we were. It's not perfect. I'm sure you'll disagree with how tariffs can get passed in the system. But when we look at that overall, it does tend to be something similar to that.
Yeah, I think in a perfect world, we got practice and theory. So in theory, you'd want, lower taxes are better than high taxes. I think anybody in wealth management hopefully can get that one right. But then when you look at what's the lesser of evils of different types of taxes, I think that's something we don't really talk about. And I think tariffs are the lesser of all the evils if we have to raise additional revenue. So, the people that hate tariffs also hate the budget deficit. And when you ask them, okay, 2.8 trillion budget deficit, hopefully 2 trillion, what are your solutions? And they say cuts. And I go, okay, what cuts would you do where you could win at midterms or a presidential election? There's really nothing that comes up. Republicans love defense. Democrats love the welfare state. There's really no cuts that are politically palatable if your goal is to continue to win federal elections. Look at the resistance that DOGE had that has largely failed. I think Republicans could very well lose midterms just by putting qualifiers on Medicare qualification. So the reality is we're not going to fix the deficit by cutting spending anytime soon, certainly not in the Trump years, I believe. So you got to raise revenue. So do you want to raise income tax on people? Do you want your taxes to go up? I don't think I know anybody that wants their taxes to go up. That's not politically palatable. I think you could raise corporate taxes. I think you're starting to get borderline there. I think tariffs are the most politically palatable one. The market is at all-time highs, and I think they've realized, oh, Trump is a rational actor. He wants a strong economy, but he's not going to push it too far. I think that's what we learned this year. We had it last time in 2018. In 2019, we learned that. But tariffs, I view more as a sales tax, where you got the foreign exporter, the importer, and the end consumer bearing the cost. But at least there's some element that a foreigner's paying. So again, of all the lesser of evils, I think tariffs are probably one of the better ones. And I think if you're out of the world of theory and in the world of practice, I don't see another option to chip away at the deficit.
I think our viewers need to hit that subscribe button because Dan's going to soon be picked up by the Trump administration. He's no longer going to be available for these podcasts. If we had tax cuts, then our revenue should have gone down, but it didn't. We know we saw a reduction in corporate taxes. So it went to the individual, and obviously the tariffs are going to go. So I wouldn't say we've had tax cuts yet.
Well, and let's go back to Trump's first administration. So this'll,
Yeah.
I know you're thinking about this. So, he passes tax cuts, which were real cuts at the time, right? Largely what's happened now is an extension.
They were real cuts on corporations, not individual taxpayers.
Because
it was revenue. It was revenue neutral.
Groups, right? Did Trump collect more in taxes after that move than the prior administration, or less?
I actually don't know.
He collected more tax. He dropped rates, and revenues actually went up.
I was going to say.
Right?
That's my point.
So I think that's going to happen again. So that also creates more revenue.
So then did taxes go up or down? If revenue went up, did taxes go up or down?
Tax rates went down, but collections went up last time.
What's the good news? If Dan's right, the market's fine. Market's in great shape.
Market's fine.
If he's wrong, those midterms will be a bloodbath, and they will have no problem getting a veto-proof tariff legislation through the system. They already have 50 votes everywhere. Every single Democrat will vote for anything against the president. It doesn't take that much. That's why I like using the 2022 example, because it could linger on a year, but you're going to see changes if this is truly hurting the system.
And I ultimately think everything that just happened with this one big, beautiful bill is just that. It was so big. It was a all or nothing type of bill that had tax, it had economy, it had social policy, all included, that not one single person, I truly believe, actually understands every single part of what's included in that bill.
So to close out, on the drawdowns, last time we said the title was "This Time is Different" or "This Time is Not Different," because every time is slightly different but tends to look very similar. And when we run it back, we said, who's the president in 2018, who's the Fed chair? Well, it's the same thing we have right now. And at the time you wouldn't have known this, but now that we've recovered from the drawdown, we can overlay the exact time period in 2018 towards the end of the year. On Christmas we started to get that rally, and we know there was a panic about tariffs. Tariffs were smaller then, they are larger now. And there was a panic that interest rates are too high, something we're constantly talking about too. And there's panic on global trade. All of it's the same thing. The anti-America trade was still going on. So it's not a surprise to see the recoveries that we have on the chart here, very, very similar.
So this time is not different?
It's not. I mean, if you look at these charts, the similarities, I mean, they're nearly identical. And it's amazing how resilient the market is. And I think just like last time, at the end of 2018, you would have been really happy if you bought the dip and positioned for a nice period of growth.
We talked a lot about tariffs. On their own, I think they pulled the market down, but they're not. That's one of the only things that I think the administration is doing that would hurt their market on its own. But we got some, hopefully now, deregulation in the system. They're trying to get banks to buy more treasuries. They even like stable coins, which buys treasuries as well and brings interest rates down. They want to get rates down. I wish Trump would stop tweeting about it every day, but he still is. They want energy prices down. All that is, those act as similar to a tax cut to the consumer. And of course, they got the bill through.
So, if you guys remember, we've already presented on this tax topic 2 times already on the Market Insight broadcast. So first one was prior to the election last year. We looked at what were the potential tax outcomes of which administration. And as you can see on the Republican Congress, we had very similar tax provisions as what you saw when we presented after the House passed the bill in February. So on our last Market Insight broadcast, what were the main provisions that we looked for tax legislation? We looked at the extension of the 2017 Tax Cuts and Jobs Act. We looked for a corporate tax rate reduction of 21 to 15%. We looked for no tax on tips, overtime, or Social Security benefits, the federal estate tax repeal, changes to the SALT deduction cap limitation, and then business expense deductions. So what actually happened now that this legislation passed on July 4th? So while taxes get the headlines, there's a substantial amount of other changes that could affect your financial plan. Here, I'm just going to focus on the tax impact without getting too much into the social or economic data, which we talked about a little bit prior to this with the all or nothing bill that we saw. So on this slide, you'll see what was actually passed versus what didn't. As you can see, the extension of the 2017 Tax Cuts and Jobs Act provisions were passed and made permanent. This is included on the lower tax brackets that you saw or the higher standard deduction. Having those be permanent is just an amazing aspect for the society, because when you're looking at that, having the uncertainty of the potential change is where I think a lot of this backlash of this bill came in, because we were already expecting it. This is what we had expected, is that there would be an extension of these provisions. So having these made permanent, I think, is a huge benefit. However, I will say one of the important things in this bill that I think not many people have commented on is there was a little bit of a doubling inflation on those lower tax brackets that we haven't yet seen what that really truly means. And what I mean by that is for the brackets in between the 10% to the 22%, they were included a double inflationary increase, meaning they're expanding those brackets. And since it's on a graded scale, everyone should see a little bit of a tax reduction, even if you are in the highest tax bracket, because that's not a phase out. So that was one of the things that, with the extension of the tax brackets, that I haven't seen commented on.
No, it
live.
has.
I've never heard that till now.
Yeah.
We were talking about it this morning. I haven't seen anybody pick it up as an article, and it's like I don't feel
It's
like there's
because
been
it's
any
2
tax
sentences
cuts
in the bill.
whatsoever until you told me that, and I'm like, okay, well, it's probably small,
It
but
is small.
but it's still, and the benefit is that everyone gets that tax cut because it's going through those bottom brackets. It doesn't matter if you're on the lower side of the income or the higher side of the income. The effective tax rate will drop from that.
And unfortunately, as you can see on the next line down, we did not get the corporate tax rate reduction from 21 to 15%. So that was a prediction that we were off on. But as you can see, most of the line items on this screen are green. Chris, you had mentioned earlier before the preparation, why do some have both? You'll see that later. I'll explain why, but it's because there's a positive and a negative. It means that it was discussed. It might not have happened exactly as what it was put into the final bill. So we'll look on no tax on tips and overtime. So for this, it's not that there's no tax on tips, no tax on overtime. It's that they're allowed a deduction above the standard deduction. For example, $12,500, the deduction is capped for single filers, $25,000 for married filing jointly for overtime pay, and for no tax on tips, it's capped at $25,000. So you're still going to see a benefit. I like that it's not you don't have to itemize to receive that benefit, but I wouldn't say it's a no tax on tips or no tax on overtime. It's just a tax benefit. And then for Social Security, there is a little X there. We were not able to have no tax on Social Security benefits. What we did see is an additional standard deduction added for those seniors over age 65. So it's increased up to $6,000 per person compared to the $2,000 it is today. So that is, goes back to those first 3 topics. The 4th topic is there was no federal estate tax repeal. However, a $15 million limitation per person in a permanent form adjusted for inflation is a fantastic improvement for where we were headed with the repeal of the Tax Cuts and Jobs Act going into 2026. So I think there's a little bit of benefit there for the ultra high net worth.
Before we go past the federal estate tax repeal and onto the SALT deductions, there's something that I have noticed on the Social Security benefits. I was actually surprised they made any adjustments, because Dan and I will argue all day long on whether there was a tax cut or a tax increase, and we'll both make our points and not hear each other.
Neither of us will know.
No, because at the end of the day, the reason the debt is running up so fast is because the off-budget liability of the Social Security and Medicare are starting to come on budget because the boomers are going up. So I was surprised to see any type of reduction. It makes sense that they didn't do no tax on Social Security benefit, because that's a way to reduce the cost to the government and slow down the runaway deficit that we have been seeing on that. Do you have any comments about this?
You were
Keep in
surprised
mind-
there's an election next year.
Keep in mind there is a threshold. There's a phase out of 150,000 married filing jointly. And when you're looking at the amount of individuals who are going to benefit from that deduction, it's the people who need it versus the high income earners that have other pensions, have other offsetting income that are coming into the Social Security, and they're going to be phased out for that deduction. So it all depends on where you are from an income perspective.
So then, do you want to talk a little bit about the changes to the SALT deduction? Because I think this is where it's confusing, where I'm always the skeptic, better known as a cynic, where all they did was broaden the base. Yeah, they lowered our tax, the marginal brackets, the percentage, but they increased the amount, at least on the personal side, on how much you're getting hit, especially if you're a high-end earner, especially if you're in a blue state.
Itemization versus standard deduction is one of the age-old loopholes that individuals try to get in the tax system. So prior to the Tax Cuts and Jobs Act, most people were itemizing their taxes due to the state income taxes that they were paying, in addition to the mortgage interest and property taxes. So and charitable giving, obviously. When you're looking at that itemization, a ton of people were itemizing before 2017. When Tax Cuts and Jobs Act came out, that standard deduction, most people were taking the standard deduction. But what was so wrong is they were limiting the amount of state income taxes that you could deduct. So that was the threshold that so many business owners and high income earners really felt, especially in those high tax states that they were at. That was where, when you say that wasn't a tax cut, that's where they got hit. But so what happened over that time? Well, business owners, especially if they're in a pass-through entity, learned about the pass-through entity election, where they could actually pay their state income taxes from the business entity and not have them go to their personal return. So there was a loophole this entire time for pass-through entities that they could still take advantage of deducting their state income taxes, but on the business level, so it wasn't even flowing through. So most business owners were now taking the standard deduction unless you gave heavily to charity or had other mortgage interest deductions that would push you up above that larger standard deduction. Now, when you're looking at this $40,000 cap, it's going to be helpful, but it also has to take into consideration those business owners that already found that loophole, and for those non-business owners that are in high taxes that are going to see that $40,000, there's income phase outs. If you're making over $500,000 to $600,000, you're going to phase out over these limits, as you are almost in every one of these benefits here, which is where it's not necessarily a tax cut for those high income earners, but the lower income earners are going to see a little bit of a benefit here. One thing I found very interesting is that there is a little bit of a marriage penalty on this provision. It was interesting that the single filers were able to deduct up to $40,000, but only married filing jointly are only able to deduct up to $40,000 on the state and local income tax deduction.
Interesting.
So it seemed to be a miss, but it's something that is in law
Maybe
today.
they used ChatGPT to write the bill.
Right, exactly.
They certainly used it to read the
I
bill.
was going to say that as well.
Well, Christina, my head is spinning, and I'm like, if you're a client and you're wondering, what does this mean for me? What should you do?
Dan, I'm an attorney. I'm going to give you the attorney answer.
It depends.
It depends. And I think that this is why this is so helpful that firms like us exist. We have a software that was updated the day after the bill was released for all of the new provisions. So I can take a tax return and put it into the system, create a tax projection, and show you what would happen under prior law, Tax Cuts and Jobs Act, what would happen if the Tax Cuts and Jobs Act weren't extended, and what would happen under this big, beautiful bill. So I can look at all of those scenarios and tell you exactly for your situation if you were a winner or someone who's facing challenges.
That's great.
So there are some additional considerations I would like to go through. Number one is the Trump savings accounts. This is for families and young children. You know, these aren't huge tax savings, but they're parts of this bill, and there are tons of parts or pieces of this bill that add little things like this that you're definitely going to want to work with the team to see if you can take advantage of. So this account would be funded with $1,000 for each child from the beginning of 2025 to the end of 2028. So if you have a child within that time period, you get $1,000. Now, how that's going to be funded, when it's going to be funded, I think that's still debatable. There's a ton of articles and news on additional contributions, how these accounts can be distributed, so that there's a lot more to come. So stay tuned for an additional blog post where I go through all of these factors.
We've always struggled with this one. I said I like it for the stimulus to the market, but it's big government with the idea of trying to fight big government. So they're saying, we'll give you money so you participate in the system so that you can say, I'm part of it, I want to see American businesses succeed. But it started off by just transferring money from the taxpayer.
Yeah. Well, and you'll see that on the limitation for itemized deduction. So obviously we talked a lot about how the state and local income tax is going to be increasing, or that limit's increasing so that more people potentially will be itemizing versus taking the standard deduction. But there's actually a limitation on that total amount of deduction that you can take for taxable income above the 35% tax bracket. So this is a difficult calculation. I would not recommend doing it on your own. ChatGPT could be even wrong on one of these. But it's something that should be taken into consideration for every specific position. Lastly, and it's not necessarily lastly, because I do have some social considerations that you do need to at least comment on, but we're not going to focus on in today's podcast. But the charitable deduction floor was changed. This is interesting. So starting in 2026, 0.5% of the AGI floor is going to be eligible before charitable deductions can be itemized. However, it's very nice because now up to $2,000 of charitable contributions can be deducted even if you take the standard deduction. So it's still incentivizing those who are taking the standard deduction to continue to give.
You said it in confusing terms, but what that means is for an itemizer, if they write a small check to a charity, it's not
necessarily getting through.
Yeah.
Yeah.
One thing that I did notice in there that I think is going to have a very positive impact, and it's consistent with what the Trump administration has been pushing on trying to get manufacturing and jobs back into the U.S. And I think this is where the actual deductions are that are going to be meaningful, and that's on R&D and being able to take 100% or accelerated deductions on equipment. A lot of that I think is going to help the economy with the tariffs being more costly to bring things in. Now it starts to shift towards domestic production, and now we're giving that a little bit more of a carrot also to people, to companies to make these investments. So I think that's going to have a big impact.
For business owners, having 100% bonus depreciation being back is extremely attractive.
I would say that if you haven't bought a large 6,000-pound vehicle with premium features, you're not going to be able to find one on the car lots for quite some time.
Right. I mean, if you remember back when 100% depreciation, we also had the chip shortage at the same time, which made finding those vehicles that you could deduct 100% very difficult. But that is something that's extremely valuable, so that you can deduct that full cost of qualifying property placed in service on after January 2025 to January 1, 2030, rather than spreading those deductions out over several years.
So Dan keeps asking who was the winners and losers. I think it is, if you're filing 1040 and it's very simple and you don't have a business, you need to open a business if you want to participate in that, because that's where you can actually add a lot of value in tax planning.
Well, and for those business owners that are under the income thresholds of 500 to 600,000, they're also going to see a benefit that QBI is placed permanently. It was something that was scheduled to come off this past year, and that's a 20% deduction on that. That was very valuable for that income phase.
And who would you guys say are the biggest losers from the bill?
I would say that it has a big impact on those ultra high net worth, ultra high earners that you're going to see on the tax side, because, and I wouldn't say it's necessarily a loser, but they're not a winner. They're not a winner in the sense that there's not necessarily a tax cut for those who are making over that $500,000 to $600,000. However, there was that extension and made permanent of that estate planning, the estate exemption. So that was a benefit for them. I do think those who are going to face challenges are on the more social side with the Medicaid cuts that you're going to be seeing in the next couple of years.
Yeah, and I think if Republicans lose in midterm elections, I think they'll point back to this moment, because the story is so good for the Democrats now of, you're cutting benefits for the least amongst us, and you're benefiting the rich. It's a classic message where Republicans could ultimately lose midterms due to this one piece, and it gets back to the appetite to make real cuts. I just don't see them
I
there.
hope that it's, they do see some benefit from the no tax on tips, no tax on overtime, because I think that population will have that level of income. And I do think that by that double inflation on those lower tax brackets, hopefully they are able to stay in the absolute lower tax brackets as longer as possible. But ultimately, I do think that is where the ultimate challenge is going to be faced.
I don't disagree that that's what the Democrat narrative will be, but I also don't think it matches up with the facts. Is that if you're making under $500,000, you saw your tax bill go down. And it doesn't matter if you're in a blue state or a red state because of the $40,000 SALT deduction. So people that are making under $500,000, I don't see, they saw a tax decrease, or at least a permanent tax decrease going forward. Yes, there's certainly going to be some issues with the Medicaid and SNAP that we still have not seen play out, but it is not a tax deduction for people that are wealthy unless they have a business. Then they may be able to benefit it depending on how they're structuring it.
That's great. And Chris, final thoughts on what do you think the impact on the market will be from this? Do you think it's largely been absorbed and it's already baked into the current prices, or do you think this is wind in the sails for some time?
Largely been absorbed. I think it goes back to some of the things that are part of stimulus. We saw this coming, the other parts that we already talked about. Maybe one thing we didn't talk about is we didn't hit, we don't have time for this, geopolitics. We're not going there, but is the world safer than it was a few months ago?
I do think there's a big dollar story that we need to maybe do a separate piece on, because whenever you're looking at the tariffs, and I think the BRICS will actually have a much higher tariff than 10% because of this going back and forth into geopolitics with dollars. I think that is another episode for sure.
We're going to have to leave it there. We're over. Thanks to our special guests. Give us a like if you liked having them on. I think it was great, but I'm a little bit biased, so that'll help us out. See you next month.